Now, when does an institution not have an advantage over you? They have an advantage over you, but if you think about what I've been talking about there, all the time is in the short term, and even in the microsecond term. But they've got no advantage of you if you look at daily charts or weekly charts or something like that. They're looking at exactly the same chart as you, and so they've got no advantage of you in doing that. And so I think that if you want to not be messed up by the institutions, trade outside the time frame where the institutions have a very, very clear advantage over you, and that is with longer time frames, like let's say hourly, daily, certainly weekly charts. They've got no advantage over you in that. Many institutional people who are looking at weekly charts, like portfolio managers or monthly charts, I would say that there are probably people in this room who are small traders who are better at doing the analysis than they are. Truly, that's true. The big difference is they've got all the money, but they may not have the talent there. So go where you've got no disadvantage, none at all there. The price and the daily chart is the same price as they see. The high, low, the close, it's the same high, low and close as they see. So they're not getting any edge over you. And you can actually outsmart them because you can study more, you can get better than they are. Experience, I think that sometimes, having said that's an advantage they have, it's sometimes a disadvantage because they don't have much time to learn. They don't learn on the job and things like that. I run courses and it's a huge privilege for these guys to be allowed off the desk for 2 days or 4 days for my courses. And, they really cherish this because nobody ever lets them off the desk. They're only allowed to, they're there to trade. They're meant to do that. That's their job, earn money. It's a really big thing to take them off the desk, whereas you can learn and you've got time to do that. So study, do study, and take advantage of it. You've got the internet, it's fantastic. Unfortunately, in our business, there's a huge amount of rubbish on the internet, particularly in investment, I think. We've got the number of gurus and witch doctors and everything like that are in this industry is appalling. It's not that easy to understand, and it's also quite appealing, the idea that there are these people that can, for $3,000, will give you some sort of secret or something like that. It's human. If he's only half right, it's good enough, for me, and things like that. The fact is, they're never going to be right. They're just exploiting a human weakness, and we get a lot of that. But there's a lot of good stuff on the internet. I mean, I learn a lot of stuff from the internet. And also, a big advantage you've got is you don't have to trade. Many of these people do have to trade. It's their job. They have to trade. A guy can't say, I didn't trade today because there wasn't anything to do. The boss will say, what? How come I paid you £10,000 today for you to sit there and cross your arms and say there wasn't anything to do? There's always something to do, or I'll find somebody else who'll find something to do. A lot of pressure. A lot of people trade when they shouldn't trade. There isn't actually anything to do and they shouldn't do it. But I am a something trader, and therefore I must keep on trading it, even if I shouldn't be doing it. And you can't say, I'm a euro trader, but I can see good opportunities in copper. No, your job is to trade the euro, even if there's nothing to do in the euro. So you can not trade, and that's actually, it's a bit like in jazz, when you not play is just as important as when you do play. Now, I must just check the time. I'm running out of time now. Who's that? It's American Psycho, isn't it? Yeah. Okay, so why do they always go for our stops? It's a delusion. They don't go for your stops. I've got 2 colleagues here. One beat, he used to work at 2 of the most evil companies in the world, Goldman Sachs and Morgan Stanley, not quite as evil. And he was a prop trader, and he had 100 million line when he was trading. I asked him, did he ever gun for anybody's stop? No, of course he didn't. He didn't know who you were, you did nothing. Like a gnat on the windscreen as you speed through there. He's not interested at all. It's a delusion to think that anybody cares. Except there is a group of people that do care. And this is my other friend here, Patrick. Patrick used to work for a prop house, which is a big prop house to this day, proprietary trading house today, and they gunned for stops, but they were people trading, clicking mouse type people, and they would just look at the ladder and what orders looked false and which were stuffing orders and which were likely to be real orders and that sort of thing. It doesn't guarantee you get it right, It's a hard thing to do, it's a skill in itself, but by down ticking you can trigger a band of orders, many of which will probably be retail orders. The retail orders are often the reason that they are hit is not because anybody was hunting for them, it's because they're placed in the wrong place. People place them in obvious places, obvious levels, so the day's high, the day's low, even the hourly high, the hourly low, if it's a very active intraday market that you're participating in, these trend line breaks, these new highs, all those sort of things, round numbers. I mean, really, who would place an order at a round number? But people do. It's such an obvious place to place an order. Too close, that's another thing. People, particularly retail investors, place their orders to their stop losses, their protection too close, so they get hit. Now you can calculate where is too close, okay? And maybe the answer is too far away, and that means you can't afford to do the trade. So how do you do this? So one of the techniques, a simple technique that anybody can use to do this, is if you use the ATR, the average true range. So many of you will know what I'm talking about here. If I say the average range, that's very simple. The average range, let's say it's 10, and we're looking at 5-minute charts. So we take the last 5 minutes, the high minus the low, high minus low, high minus low of the last 10. Add them together, divide by 10, that gives you the average high-low in the last 10 bars. The word true just counts for gaps, okay, so we can ignore that for a moment, but that's what the true part of it is. So the average range. Now what that means is if you place a stop inside that, on average, you will be stopped out when nothing happens. Now a lot of people would do that. So the market is going up and down with nothing happening. You've worked out what nothing happening looks like. It's the ATR there. And so you must place your protection outside the ATR. You do want to be stopped out if the market moves unusually against you. So you have to define what is unusual. And to know that, you have to know what's usual. So unusual is a multiple of usual. So if we say the ATR is 12 pips or something like that, then you say if I place an order within 12 pips of here, with nothing happening, just in normal behavior, I will be stopped out. That's quite normal. So I want to not be stopped out because of just normal trading. I wanted the market to move against me by a meaningful amount. Then you have a factor, and it might be 2, for example. And you say if the market moves 2 ATRs against me, I want to be stopped out because the market has moved unusually, and unusual is defined as twice usual, in the wrong direction. Now do that. That's a simple thing you can do. ATR, you can run that at the bottom, double it if you want. You choose your own safety factor. But if you know at least where you mustn't place a stop, otherwise you're going to be always stopped out because nothing actually happened and you were stopped out because you placed it too close. That's the definition of too close. Okay, I'm coming. I know you're all desperate to get to a drink, so I don't want to hold you up any longer. I'm going to end with this slide. There are a couple more slides. I think you're going to be able to have the slides if you want. But about things which are called manipulation in the market. Often these are not manipulations. Short squeezes and things like that. They're not. It's not a manipulation. It was just that's what happened. People were wrong, and they were big wrong. And they were very powerful people that were wrong. They were institutional people that were wrong. That's why Tesla's gone up like a missile, because they were caught. It wasn't manipulated up. It was because they all got it wrong. And this is often the case. You get squeezes. Your oil currently today has gone into backwardation. It's a nearby squeeze. It's not a manipulation. It's a short it's a delivery problem nearby. These things happen. So there is manipulation, but it's generally a lot of things are called manipulation, which are just factors of the market itself. Manipulation itself is, of course, illegal, manipulating the market, and people won't do it because they will get caught. There's so many people watching, they will get caught, and the penalties of getting caught now are enormous. And so they're watching and making sure that individuals inside the institutions are not going rogue and putting the institution's reputation with regulators and getting these enormous fines, which they do get if they do it. And they really are on top of this now. I was an expert witness for just recently for a guy that was doing order stuffing, and the regulators had come had first of all demanded massive amounts of data on all his trading. Then they had put enormous resources into analysing this data and proved the guy was doing it. And I was supposed to be for the defence. He never went to trial because the lawyers told him, give up, just plead for mercy and take whatever the fine is, because you were doing it and they've caught you doing it. And he was caught, and it was a lot of money that he had to pay. He would get caught. They know, they've got computers, they've got artificial intelligence, looking at these things now, they're going to catch you doing it. And the reputational damage and the financial damage is just too big for companies. So I don't think it's ever been cleaner, really, than it is now for these reasons, because the penalties are so big. So I think I probably should stop now. I've talked a lot. I hope I've explained the two sides of the game, really. Don't be afraid of the institutions, but do respect the position they're in. And they don't really notice you, and they don't hate you or anything like that. They don't know anything about you, really. You're just there, and you're trying to play in their game. And don't be surprised if they run you over, and they won't even notice that they did. And there's nothing that they hate you or anything like that. That's generally the case. But you should think about where you've got advantages over other people. Where have you got advantages is in not the short term, where you've got clear disadvantages over institutional traders, but in the intermediate and long term, I would say you've got no disadvantage over them. You've got exactly the same data as them. By the time that news is read by you in your newspaper, it's a day old, but that's now it's the same. It's a day old for them too, and so you have no disadvantage whatsoever. So go where you've got no disadvantage, and in some of that you've got clear advantages. You've got the advantage of you've got time to study. Don't have to trade. You can learn. It's a step-by-step process for you. They've got a lot of pressure to make money. And also I'll just say one other thing, which I was going to mention in a moment, is to do with size. Having big size creates enormous problems for funds, and you don't have that problem. For example, they can't sort of trade like I've just said, market approaching the uptrend line, then we have a white candle, we buy it and look for a swing to a new high. It's very hard for them to do that, because how do they buy enough at that level? By the time they start buying and form that white candle and follow the market up, all the offers are disappearing and it's halfway to their objective. And for the trade to be worthwhile, they have to do very large sizes in it. So they can't do that kind of thing, but you can. And you can make money from that part of the market movement, which they can't participate in. So, go where you've got pluses and advantages, and don't, as many people do, try and compete with the big boys, and you won't win. That's the short message. Don't trade in the data releases, the non-farm payrolls and things like that. You cannot possibly have any advantage over those sort of people. They've been and gone by the time you've heard it for the first time. I think that also the short term is an area where they're definitely going to dominate, and even down to the microsecond high frequency trading. They rule that area there. Go where they don't rule, and you've got no disadvantage to them.